Good morning. Today we're going to talk about innovative qualified retirement plan strategies for the upcoming year to increase assets under management. My name is Gary Kushner. I'm the founder and president of Kushner and Company. And as part of our efforts to reach out to our partners in the financial advisor and broker community, we want to do this as a part of our ongoing annual reach out to provide you with more important and upcoming information so that both of our firms are able to succeed. So, with that, let me launch right in. The whole purpose of having a qualified retirement plan is it provides a unique option for a business owner to help meet their business goals by providing significant tax benefits as well as really acting as an employee attraction and retention tool. At the end of the day, this is part of an overall total compensation program, and more employees of all ages and prospects of all ages, prospective employees, look at the types of retirement plan options that are available to them. And it can help achieve meeting retirement goals by dramatically increasing retirement savings. You go back to the formation of the Social Security system in 1935, where people were leaving the workforce in large numbers and leaving it in going into poverty. And that was granted during the Great Depression. But that was part of the realization, even on the part of employers, that they needed to provide some mechanisms to offset and increase employees and retirees' income streams. Another objective for many, certainly small to mid-sized employers, is to maximize the owner's contributions to the plans, and at the same time, often to minimize the contributions for staff. And lastly, one of the significant plan objectives of a qualified retirement plan is to add flexibility. That is, moving more to a defined contribution model where employers may have a wide range of flexible options on funding, depending upon the type of business year that they've just had. Whereas in a defined benefit plan, funding is often determined and obviously by the actuary and the requirements for funding, regardless of how good or bad a year that employer may have had. So today we're going to cover new tax law applications and enhancements. I'll cover a bit of both the Secure Act and Secure 2.0. We'll provide the new 2026 IRS limits for qualified retirement plans, offer some opportunities to close new business and how to know whether your clients are prospects for a qualified retirement plan or not, how to avoid raiding by the competition, and then we'll talk a little bit about some cutting edge plan designs that we're seeing and helping small, mid-sized businesses succeed in meeting their employee attraction and retention goals through the qualified retirement plan. So let's talk a little bit about Secure and Secure 2.0. The Secure Act had a number of provisions impacting qualified retirement plans. One of them, very favorable, the moving the deadline to adopt a new plan, not just by the end of that plan year, tax year, but now until the tax return is the due date for the tax return extended. So I could technically establish a brand new defined contribution plan by as late as October 15th of 2026 for the 2025 year. The exception is that if I want 401k, a 401k component, either regular 401k or Roth, I still have to adopt it, obviously, by the end of the year because those are uh, contributions made by employees via the payroll system. So once the tax year ends, if an employer is unable to allow 401k contributions for that previous year. However, there's one exception to that exception, and that's that solo K plans can treat the first year's contributions as elective deferrals if it's made by the due date of the owner's income tax return, not extended. So April 15th of 2026 for a 2025 plan year. Secure added new provisions for what it terms long-term part-time employees, or LTPTs. You'll start to see that acronym more often. This started last year in 2024, and the rule in the Secure Act was that if an employee, a long-term part-time individual, had 3 consecutive years with 500 to 999 hours in each of those years, they needed to be eligible to participate in elective deferrals within an employer's defined contribution 401k profit sharing plan. This, you're going to see in a moment, is going to be changed in Secure 2.0, but it now means that employers are going to need to begin tracking those part-time employees each year and to determine if they had consecutive years with 500 to 1,000 hours or more, 999 hours or more in 3 consecutive years. We are now able to add safe harbor non-elective contributions mid-year or even after the year ends. So if I decide that as the plan year is progressing and I'm a non-safe harbor plan, I can't change to a safe harbor match mid-year, but I can change to the safe harbor non-elective if I realize I'm going to fail my ADP or ACP testing. If I add mid-year at least 30 or more days before the year end, it is the normal 3% non-elective safe harbor. However, if I add it before the last day for distributing excess assets, typically March 15th of the subsequent year, I can add it retroactively, but now I must make a 4% non-elective safe harbor contribution. So we have some new flexibility and a new mechanism if we're failing the ADP ACP testing in after the end of the plan year. There are new small employer tax credits for establishing a 401k profit sharing plan. If I have up to 100 employees who earn at least $5,000 or more in the prior year, I can get a credit of 50% of the cost to set up and administer the plan, up to $5,000 if I also provide auto enrollment during those first 3 years. We'll talk about auto enrollment in just a bit as well. So there's the ability for some very favorable tax credits to offset the costs of establishing a new 401k. Secure also changed the requirements for RMDs, required minimum distributions. And it is doing it on a phased basis based upon the year of birth of the individual. So if a plan participant was born July 1, 1949 or earlier, age was 70 and a half, just as it has been for the past 20 or so years. On or after July 1, but before January 1 of 1951, that age is now 72. On or after January of 1951, but before 1960, the age is 73 when you must begin required minimum distributions. And if born on or after January 1, 1960, that age will increase to 75. So you'll want to talk with us about RMDs. We have already implemented this and are providing that information to employers and to participants as they begin approaching their required minimum distribution age, often the required beginning date of their RMDs. A big change, not a positive, is that the Secure Act shortened certain beneficiaries' payout timelines. Spousal payouts are still done in much the same way they were previously, but any other, what now is referred to as a non-qualified beneficiary, in essence, the Secure Act eliminated stretch IRAs and other payouts over the long-term life expectancy of the beneficiary for a non-spousal beneficiary. This is requiring a lot of your clients to now go back and look at their estate plans for providing these benefits, because in some cases, there will be a 5-year up to a maximum 10-year for non-spousal beneficiaries to be receive their full distribution. And while we initially thought back when Secure was first passed that individuals could wait until the 10th year and take out all their money at that point in time, the final regs made that quite clear that it had to be spread out over the 10-year period of time. You couldn't just wait until the 10th year. And a new optional provision, or something called QBADs out of the Secure Act, qualified birth and adoption distributions. These are optional for employers to adopt within the plan, no pun intended, but QBADs allow an adopting employer in the plan, allow their participants to take a distribution out of their 401k and other accounts to offset some of the costs of birth and adoption. I will say, while that has been available, we're not seeing a lot of employers actually adopting them. That was QBAD optional provisions. Then along came Secure 2.0, and it now made some additional changes both to Secure and to prior law and regulations. So it now extended the deadline to amend an existing plan to increase benefits in the immediately prior plan year, and that's extended to the due date with extension of the employer's tax return. So if I decided in the following year, plan year, that I wanted to increase benefits, I had until potentially October 15th of that year in order to increase those benefits within the plan. We have a new category under Secure 2.0 of super catch-up contributions for those aged 60 to 63 by December 31st of each year. And it allowed for an additional amount of catch-up, 50% over that year's regular catch-up, indexed to inflation, for those individuals aged 60 to 63. And those super catch-ups are optional within the plan, but we do see a lot of employers adopting super catch-ups for those individuals 60 to 63. A new rule that is not optional. Mandatory Roth catch-up contributions starting next year must be made in the form of a Roth contribution. And it's only for those individuals earning $150,000 or more on the prior plan year. So starting in 2026, if I earned 150,000 or more in 2025, looking at the W-2 box 3, that is Medicare wages, which if you recall, are unlimited. That's where you look to determine for those individuals earning 150,000 or more. In 2026, I must, if I want to make Roth catch-up contributions, I must make them as Roth. This is going to be a significant challenge for some of your clients and their payroll providers because my sense is, based on the final regulations that just came out in the last couple months, we're going to see a lot of payroll providers that have not identified those individuals. Their systems weren't set up for this, but they are going to have to make this occur. I'll be doing a webinar in 2026 to help employers and their advisors on just how to look at and make sure that these catch-up contributions for the higher earners are in fact being done as Roth. Well, we barely had the new long-term part-time, the LTPT rules put in place by Secure when Secure 2.0 changed them. It reduced from 3 years, 3 consecutive years, having to allow elective deferrals by long-term part-time employees down to 2 consecutive years starting this year, 2025. But I can now exclude bargaining union employees. From a plan design perspective, I may need to look at, if I don't already have, dual eligibility requirements. By that, we mean eligibility for the 401k elective deferral components of the plan and different eligibility requirements, perhaps longer eligibility requirements for match, match, and non-elective contributions to the plan. So a lot of your clients probably do, if they don't have immediate eligibility for everything, may already have dual eligibility requirements. If they don't, and they tend to have any number of long-term part-time employees, they may want to look at amending the plan to institute dual eligibility. It also increased those RMDs to the 73 and 75 starting in 2023 and 2033. So you're going to want to make sure that your platforms, your record keepers, and we're already have implemented this and are tracking it for your clients. You're going to want to take a look at that as well. Secure 2.0 offered up a number of optional plan designs that employers can implement in order to, if they so choose. And I will tell you that some of these we are already seeing employers adopt operationally. Plan amendments for these are not required for another year or so, a little over a year, but operationally they can put them in place. The first is allowing participants to elect Roth treatment for employer match and non-elective contributions. Now, in the past, those were considered regular contributions, tax-deferred contributions. But if an employer plan sponsor wants to amend the plan and give participants the ability to elect Roth treatment for those employer contributions, they can. I will tell you that to date, we haven't seen many employers wishing to adopt this when we discuss it. And in large part, it's because many of those record keeper platforms are not set up to allow for this. This is an area you're going to want to take a look at in the future, and we'll be updating you on a regular basis as as we see employers making that decision. The second is an issue that came out of a private letter ruling, a PLR, about 4 years back, and it got a lot of traction in Congress and got included in the Secure 2.0 Act. And that is a recognition that a lot of younger employees were coming out of college or technical school with significant student loans, and because they were starting to have to repay the student loans, weren't able to make financially able to make contributions to the retirement plan. And so Secure 2.0 allows an employer to optionally treat a student loan payment. It has to meet certain qualifications, but a student loan payment as if it were a 401k deferral or 403b deferral, and then treat it as such for match or other contributions, employer contributions within a plan. This is another optional plan design I'm not seeing a lot of employers adopt, with the exception of some professional service firms where they are regularly hiring newer grads. I have a couple medical practices that began doing this because by the time you come out of medical school, you typically have mid six-figure student loan debt, and those new docs weren't able to make elective deferrals into the retirement plan because their student loan repayments were so large. But again, that's a new option that you and we can talk about with our clients. One of the new optional features that I do see a number of employers looking to implement is increasing the forced cash out limit from the current $5,000. It is now under Secure 2.0, $7,000. And so at this point, we are seeing employers making those arrangements. Now, remember, we've always had the ability to force out contributions. That means not require an employee or participant's consent if it was $1,000 or less in their account balance. And we can even optionally exclude rollover contributions from that total. Between 1,000 and presently 5,000, I still I could force them out if I provided a directed IRA contribution. So I would go out and find an IRA custodian, typically the platform or record keeper where the dollars already existed, and then force out that contribution from 1,000 or account balance between $1,000 and $5,000. Now that if I adopt it, can go up to 7,000. Still have to make those arrangements with the IRA custodian and provider, but I can do a forced cash out, not requiring the participant's consent. If it's over 7,000, I still, just like before at the 5,000 limit, I still am required to get consent from the participant. We have new, again, all optional within the plan, hardship withdrawal rules liberalized for 403b plans. Now they more closely mirror the 401ks. Our 403B clients, I'm not seeing rushing to adopt this just yet, but it is now available. For all employers, they can optionally allow individuals to self-certify that they are having a hardship. I don't believe we yet have one plan sponsor adopting this. Um, Mostly because we all have fun stories. My favorite was about a decade and a half ago. We got a call on a Friday afternoon from a participant in one of our clients' plans requesting a hardship distribution, and they needed it that day. And the our account manager inquired. It says on the form, what's your hardship? Is it, you're about to be evicted from your apartment or your house, or missed the mortgage payment, and you're going to lose your house, medical emergency. No, he was having a kegger the next day and needed $100 hardship in order to provide for the kegger. Under the old rules, I looked carefully. That was not considered a hardship. Now, with self-certification, if an employer chose to adopt that optionally within the plan, that participant could have gotten his $100, although I don't know that it would have gotten there in time for his kegger, but certainly could have received it. Another optional feature under Secure 2.0, you can allow for distributions for domestic abuse victims. There's a whole new set of rules about how that operates. And those domestic abuse victims do have the option, if an employer adopts that provision to allow for those distributions, does have the option to repay that distribution over as long as a 3-year period of time. Similarly, again, optional under Secure 2.0, a participant who received a QBAD, a qualified birth or adoption distribution, could repay that over a similar 3-year period of time. Not a requirement, but they could be allowed to do it. And it would not count as an annual addition, or would not count towards the 401k limits. They could repay that, or the annual additions limits under Section 415 of the tax code. They could repay it over a 3-year period of time. Newly enacted, again, optional, you can allow for distributions for federally declared disasters. This hurricane season was extraordinarily unusual because there were none that hit the U.S. mainland this year, first in a long number of years. But there were many other federally declared disasters. A plan can allow for something similar to a hardship distribution in that instance. And a new provision, again optional, if I was under age 59 and a half, recall there's a 10% penalty for distributions received under age 59 and a half, but a carve out for an individual who was deemed to be terminally ill, they could receive a pre-59 and a half distribution without that 10% tax penalty. Another new optional feature that could be added to a 401k, in-plan emergency savings accounts. I'm not seeing a lot of employers requesting it. These are after-tax accounts that an employee could contribute to. It's something akin to the old Christmas club at your local bank, or if I really go back, savings and loan. If I go back 40, 50, 60 years. So a number of new options for our clients, yours and ours, for them to consider. One of the things we're doing as part of our reviews each year is bringing up all of these optional items and asking employers, is this something, each of our clients, is this something you're interested in? And as I say, some of the items, there's a lot of interest. Many of the items, there's either a wait and see or no, we're not going to allow that. But something to keep an eye on. Later than usual this year, due to the government shutdown, we got our 2026 IRS limits announced for retirement plans and across the board. We have a $1,000 increase in the 401k, 403b elective deferral, whether regular or Roth, from 23.5 to 24.5. The regular age 50 plus catch up goes up $500. So next year, an individual could contribute, a 50-year-old or older individual could contribute up to $32,500 if they were also between 60 and 63. The 24.5 plus 11,250, they could contribute, up to $35,750 if they were 60 to 63 years of age by December 31st of 2026. Brand new, we talked about the Roth catch-up requirement. If compensation was greater than 150,000 in the prior year. I'm going to skip the simples. We're seeing fewer and fewer simples, in large part, as you can see, much more limited for especially business owners than a regular 401k. The maximum annual addition, so the 401k plus all employer contributions, cannot exceed 72,000, up from 70,000 last year. Highly compensated employee, the definition stays the same, 160,000 next year. The key employee goes up 5,000, and the maximum compensation that we can consider for a qualified retirement plan goes up 10,000 next year, from 350,000 to 360. By the way, if you need, this chart is available on our website in the blog section. All you would need to do is search on 2026 limits, and you would find this chart, and it's extended for health and welfare benefits as well. So the opportunities to close new business for you. Really, we see this as only one question to ask a business owner, business prospect. Do you have a retirement plan? If the answer is yes, do you want to increase the tax-deductible contributions that the business can take? Are you looking to reduce staff cost while possibly increasing contributions allowable for the owner and highly comped? Are you looking to add flexibility to the plan? And do you need to look at improving administration and services? We're hearing more and more from financial advisors that some of the platforms are doing a much better job than others. We're seeing a lot of payroll providers providing horrendous service to employers, and them looking to move away from those large payroll providers that may do a wonderful job on payroll, but a terrible job on investing and compliance work on qualified retirement plans. Same question, do you have a retirement plan? If the answer is no, how are you and your employees saving for their own retirement? And would you like to reduce taxes? that your business pays. All of the contributions that are made to the plan do reduce the business's taxes because they are in a qualified retirement plan. They are tax deductible as an ordinary and necessary business expense. I love this chart for the building blocks of plan design. So I have a two-person firm just to show the capabilities of the different types of plan designs that we can use in the defined contribution area. So if I have a profit sharing plan with an owner that makes 350,000 this year, these are all 2025 numbers, and one employee that makes 50,000, I can do a non-integrated profit sharing plan that provides everybody with 20% of their compensation. And you'll see that it costs 70,000 for the owner. The owner typically isn't going to be concerned about that, but 10,000 for the staff member. I can integrate the profit sharing plan with Social Security, and that'll slightly reduce my staff cost while allowing me to continue to make 70,000 contribution as the owner, the total of all the profit share. Those are pretty basic plans. Don't tend to see a lot of them. On the FAIR model, I can go, okay, I'll do a 401k with a 3% safe harbor and profit sharing, and the owner, I can still do 70,000. Now I can almost cut in half the amount of contribution for the lone employee from 10,000 under the basic all the way down to 5,230, 10.46 of their pay. Okay, that's not terrible. Even better, I can say I'm going to do profit sharing with a 401k safe harbor match, as long as my plan isn't top heavy here, and that's fine. Now I can reduce the cost almost by 2/3, a little over 2/3 for my staff member while maintaining the owner's contribution. If I have an older owner with a younger employee, I can still reduce that further with a new comparability profit sharing plan. Now I get my same 70,000 for me, but at an employee cost of only 2,500. But the two best is new comparability with a 3% safe harbor, costing me my staff cost of $2,200, or new comparability with a safe harbor match. And now I'm down to $1,550. So you can see lots of options in plan design based upon what that owner might want to do. And in every case, that owner is able to put away the maximum amount of a defined contribution plan, again, using 2025 numbers. Here's an actual case study from one of our clients where I had 4 owners, family members in this case, each earning $350,000, and 4 younger staff members there. And we were able to put aside, because all of the owners were 50 or older, we were able to get aside, again, 2025 numbers, 77,500 for each of the 4 family members at a cost of $5,000 total for each of the staff members. We did this through new comparability and a safe harbor. Of the roughly $315,000 that went into the plan, 310,000 of it was for the 4 owners, 98% of the employer contribution. So we can do some pretty significant design options for owners that want to maximize their contributions and minimize staff costs. Not every owner fits in that. Matter of fact, we have one client where the owner excluded himself from participating in the plan. The plan document actually excluded him because he wanted to make sure that more of the money went to the staff. I will tell you, he's an exception to the rule. We have a lot more owners in the other category. So opportunities to close new business, seek out those business owners with SEPs or simples, um, or if they have an old regular standard 401k or 403b. Uh, for owners that are looking for greater tax deductions and greater savings for themselves, SEPs and simples don't provide the same opportunities that a 401k, when combined with some of the newer plan designs, can provide. And for those that are willing and where it meets, consider combo plans where I have more highly compensated owners and highly comped employees that are older with younger staff members. Um, a combo plan is the combination of a 401k profit sharing plan and a cash balance defined benefit plan. The costs of establishing these is relatively minor compared to the potential hundreds of thousands of dollars that owners can have contributed on their behalf into the plan. We're starting to see some, if you will, rating by competitors in the financial advisor community. Our suggestions here: team up with us to bring new ideas on how to consider implementing the new laws and regs, Secure and Secure 2.0. Team up with us and we can help advise clients when they get our experience is when that client sees more hands-on, proactive involvement by the financial advisor and us as the TPA, they tend to want to stick with both of us and utilize us to look at and model different, more sophisticated plan designs like we just discussed in those situations where the owner is looking for maximizing contributions for them and minimizing staff costs. Some cutting edge plan design considerations. We see a lot of employers, plan sponsors, still utilizing the HCE definition when they have lots of highly compensated employees. There's a rule that's been around for a few years now where I can limit the number of top paid HCEs when I have large numbers of them and only take the top 20. So, for example, we have a medical practice with over 75 docs out in the not in Michigan, but out in other parts of the country. We were able to provide significant increases and be able to pass ADP and ACP by not counting all 75 of those docs as HCEs, but only counting the top 20. Again, we have a lot of hoops to jump through, but we can do that. Think about your professional service firms, medical practices, law practices, engineers and architects. We're able to do some pretty substantial considerations there where there are large numbers of HCEs. And like we showed earlier, examine non-elective plan designs for greater than just pro rata contributions. Everybody gets the same percentage of compensation. We can do so much more in those circumstances. And feel free to use us to help you model some of these offerings for our clients. Take a look at those combo plans when you've got the 401k cash balance combo. when you have the right demographics. Typically older, um, and greater disparity in compensation between the owners and highly comps and the staff. Think of a dentist office or a medical provider, combined with younger, less comp staff. Those will get you the greatest results, that the disparity on age and compensation. The best ways to stand out from your competition: bring new laws and regulatory options to your clients and prospects. Help them see what is available for them. The rules have changed substantially in the qualified retirement area due to Secure and Secure 2.0. So take a look at what you're able to do and provide qualified retirement plan solutions that are both cost effective and may favor the owner, customized for that owner's business. Timing is everything here. Competitors will be knocking on your clients and prospects' doors with these new items, and you want to get there first. We're seeing this over and over around the country. When you pair with us as a TPA and plan designer, you are going to have considerably more expertise than many of your competitors. And that is going to help land new prospects and keep your clients that you already have. Why do you want to work with Kushner and Company as a TPA and compliance service provider? Every one of our clients has a dedicated account manager versus the large payroll firms and others where they call an 800 number black hole. Get a different answer with everybody that they or their participants talk to. Unlike 94% of other TPAs in the country, according to a survey that was done by one of the major record-keeping platforms, we reduce our fees by any investment platform revenue sharing we receive on a dollar for dollar basis. So we have a number of clients that their cost for us out of pocket, either out of their pocket or the plan assets, participant accounts, is zero. We get enough revenue share from the platform that when they get a bill, it'll show our fees and then the reduction, in many cases, all the way down to zero for mid-size and larger plans, because we apply a dollar for dollar reduction in our fees for all rev share received. We actively manage and monitor your clients' plans. We're very proactive. If we see that issues may be arising, we'll reach out to you and the client to let them know what fixes they may be able to do still this plan year, or if it's after plan year end for the prior plan year, the timing and fixes they may want to implement. We have local and national ERISA attorneys on call. I would say 24/7. That's not quite fair, but we're part of a large group of ERISA attorneys, actuaries, and CPAs that we're able to get any and all of our clients' ERISA questions answered, usually within one business day. While we don't have any actuaries on staff, we used to in our early years, 43 years ago, about 40 years ago. We now work with nationally recognized actuaries on our defined benefit and combo plans, and we partner with them on combo plans where we handle the 401k and defined contribution portion of the plan, and they handle the defined benefit. And then we work together to provide the 5,500, the combined 5,500 at the end of the year. But probably the best reason for working with Kushner and Company, we offer what our clients tell us is world-class service. One of our clients said, we're Nordstrom, not Walmart. They're both retail giants, but the service that you get at a Nordstrom versus the service you get at a Walmart are two different things. So with that, I'll open it up to any questions anyone may have. If you do have any questions after this, or if you're watching the recording, please feel free to reach out to us. My contact information is on the title slide of this presentation. And with that, we appreciate your time and attention and look forward in the future to continuing the great work that you do and that you allow us to help with. Thanks again. Bye now.